Welcome back, Focus Learners. Today on The Explainer, we're doing something absolutely thrilling if you're an investing nerd like me. We are taking a real live stock and dropping it straight into the ultimate GRU gauntlet. Seriously, we're going to evaluate one single company using the classic time-tested valuation frameworks of three absolute legends: Warren Buffett, Peter Lynch, and Benjamin Graham. And then, we're throwing it into the deep end of a rigorous discounted cash flow math test. Get ready, because we are extracting all our clues directly from the company's recent earnings reports, SEC filings, and balance sheets to see what this business is actually worth.
Okay, let's dive into our roadmap for today. We'll start with meeting the challenger. Then, Test 1, the Buffett lens. Test 2, the Lynch lens. And Test 3, the Graham lens. After that, it's time for Test 4, the math test, before we wrap the whole thing up with our synthesis and final verdict.
So, who exactly is brave enough to step into the gauntlet today? Let's introduce Section 1, the challenger, Sylvamo Corporation.
Let's get a quick snapshot of the business. Trading under the ticker SLVM, Sylvamo is currently priced at $39.66 a share, which gives it a market cap of about $1.58 billion. They operate in the basic materials sector, specifically paper and paper products. Look, if you've ever used printer paper, educational materials, or commercial printing sheets, you've almost certainly touched their product. They're a global producer of uncoated freesheet paper, actually spun off from International Paper back in 2021. So we're dealing with a mature, highly physical business here. No flashy software multiples, just raw materials, massive mills, and global supply chains.
That brings us to our very first trial by fire. Test 1, the Buffett lens. As we know, Buffett is always hunting for an economic moat, honest management, consistent earnings, and a solid return on equity with manageable debt. Let's see how they stack up.
Right off the bat, let's talk about management. Buffett absolutely prizes honest, highly transparent management teams who are willing to admit when things get tough. Sylvamo's CEO, John Sims, wrote this exact quote in his recent letter to shareowners: "I will communicate transparently while providing context, rationale, and honest assessments of our decisions and performance." And you know what? He backed it up. In that very same letter, he explicitly acknowledged the cyclical industry downturns in Europe and supply constraints at their Eastover mill. He isn't hiding the bad news from investors, and honestly, that's a massive checkmark in the Buffett column.
Now, what's really interesting about this company is how we have to contrast their moat with their financial health. Paper is, by definition, largely a commodity, which usually means a narrow or even non-existent moat. But Sylvamo has a pretty unique asset: their Brazilian forest lands. These forest lands actually serve as a significant source of intrinsic value and give them a very real, sustainable cost advantage in Latin America. You pair that with a solid return on equity of 10.8% and recently refinanced long-term debt that pushes their term loans all the way out to 2032, well, their financial health looks surprisingly robust for a commodity player.
But what about Buffett's absolute favorite metric, owner earnings? Right now, it's true. Sylvamo's current earnings are taking a cyclical hit. However, management has clearly outlined a target to generate greater than $300 million in annual free cash flow within the next 3 to 5 years. This is being driven by strategic investments and a massive multi-year lean transformation. If they hit that $300 million target, that serves as a fantastic proxy for Buffett's owner earnings. Assuming a required 10% return for a commodity business, Buffett might value the whole operation at $3 billion down the line. But today, with the cyclical uncertainty we're seeing, he'd likely demand a steep margin of safety, probably wanting to buy in somewhere closer to the $30 range.
All right, let's shift our perspective and run the company through Test 2, the Lynch lens.
Peter Lynch loved categorizing companies and really digging into the stories behind the numbers. In his terminology, Sylvamo is a classic cyclical that is currently navigating a turnaround transition year. The entire European paper market is experiencing a significant downturn, and Sylvamo faced some brutal Q1 mill outages. I mean, they had a broken debarking drum at their Niemöller mill that's costing them an extra $1 to $2 million per quarter until it's finally fixed in September. Lynch would instantly recognize that the stock's performance is going to swing wildly with these cyclical economic tides and operational hiccups.
And this cyclicality brings us to a rather dramatic number, a PEG ratio of negative 0.1x. The price-to-earnings growth ratio is a staple Lynch metric, right? A PEG of 1 is fair value. Anything lower is fantastic. But negative, that happens when your recent earnings drop straight into the red. Sylvamo reported an adjusted Q1 operating loss of 53 cents per share, which totally skews this traditional Lynch metric. When the peg breaks like this, Lynch tells us we have to look deeper at the balance sheet and institutional support.
And looking deeper reveals some surprisingly strong Lynch positives. Sylvamo boasts a current ratio of 1.55, meaning their short-term assets easily cover their short-term liabilities. They also just extended their accounts receivable securitization out to 2029, which brilliantly locks in their liquidity. Furthermore, their largest shareholder, Atlas, is strongly supporting the current turnaround strategy. Top the whole shebang off with a consistent quarterly dividend of 45 cents per share, and Lynch would see a company that absolutely has the financial armor to survive the cycle until the turnaround is complete.
But as we know, mere survival isn't enough for our next guru. Let's transition to test 3, the Graham lens.
Benjamin Graham, the legendary father of value investing, was notoriously strict. He wanted hard numbers and deep, deep discounts. So, the crucial point here is how Sylvamo holds up against Graham's famous defensive investor checklist. Let's walk through it together. Adequate size? Yes, at $1.58 billion, it easily passes. Strong financials? Yes, that 1.55 current ratio passes Graham's liquidity test with flying colors. Earnings stability? Uh-oh, here it fails. That $3 million net loss in Q1 violates Graham's strict demand for 10 years of unbroken positive earnings. Dividend record? Passing with that steady 45-cent payout. Moderate PE? At 15.8 times, it squeaks by Graham's threshold of staying under 15 to 16 times earnings. It's a really solid scorecard overall, but that earnings dip is a glaring strike for defensive investor.
So, let's take it a step further and apply Graham's classic intrinsic value formula to find a hard price target. First, because of that recent earnings hit, we need to extract a normalized implied trailing EPS. We take the current price of $39.66 divided by the stated PE of 15.8, and that gives us an implied EPS of $2.51. Second, we calculate book value per share, taking total equity of $979 million and dividing by the 39.8 million shares outstanding gives us $24.59. Finally, we plug these into Graham's magic formula, the square root of 22.5 multiplied by the EPS multiplied by the book value.
The result? We get an intrinsic value of $37.26 per share. Now remember, the stock is currently trading at $39.66. Graham famously demanded a margin of safety, often wanting to buy a stock at 2/3 of its intrinsic value. Since Sylvamo is currently trading above Graham's calculated intrinsic value, this strict value framework would label the stock overvalued today. It simply lacks the required margin of safety Graham would insist on.
Okay, we've seen the qualitative gurus. Now let's shift gears entirely to pure, unemotional numbers with test 4, the math test.
Let's move to our models and see how this builds a case for fair value using a discounted cash flow analysis. For our base case DCF, we have to make a few grounded assumptions to fill in the gaps. First, we take management at their word that they will indeed hit that $300 million free cash flow target, ramping up to it over the next 4 years as their Eastover Mill investments finalize. Second, we apply a weighted average cost of capital, or WACC, of 9%, which is pretty standard for paper industry averages. Finally, we assign a conservative terminal growth rate of 1.5%. We have to be realistic here. Uncoated paper is a mature, slowly declining industry. When we actually run those numbers, look at what happens in our sensitivity table. Following the middle row and middle column, so that's our 9% WACC and 1.5% terminal growth rate, our base case DCF yields a fair value of $55 per share. Think about that. If you believe management can actually hit their cash flow targets, this math suggests the stock is currently significantly undervalued at $39.66. That offers a very, very compelling upside for investors willing to wait. But as analysts, we should never rely on just one model, right? When we look at alternative valuation methods, a fascinating split emerges. The Wall Street analyst median comparable target sits right next to our DCF at $56 per share. However, if we run a dividend discount model, assuming an annualized $180 dividend and a 2% growth rate, the fair value drops to roughly $26.22. Now, you might be wondering why the massive gap. It's simple. The dividend model only values what the company is paying out right now, while the DCF and Wall Street targets are actively pricing in that massive future $300 million cash flow target.
So, we've officially run the gauntlet. It's time to bring all these clues together for Section 6, Synthesis and Final Verdict.
And this brilliantly illustrates the beauty and honestly the sheer frustration of stock analysis. Different frameworks yield completely different perspectives based on the exact same data. The Buffett lens wants a wider margin of safety, looking to buy around $30. Lynch wants to wait for the cyclical earnings to stabilize before jumping in. Graham views it as fully priced at $37.26 and would probably pass. But the forward-looking DCF and Wall Street models, they are screaming buy, with targets up in the mid-50s.
What you really have to remember is that every single one of these wildly different targets springs directly from the exact same reality, the company's balance sheet. Sylvamo has nearly $1 billion in equity and a rock-solid current ratio, but it's currently weathering a severe operational storm. The past numbers are rocky, for sure, but the future projections, they are highly lucrative.
Ultimately, the true value of Sylvamo depends on whether their qualitative strengths can overcome their real-world risks. Their core strengths lie in that incredible low-cost Brazilian forest land and the massive optimization project happening right now at their Eastover mill, paired with an aggressive multi-year lean transformation. But we can't ignore the risks. Severe cyclical downturns in European paper demand and near-term logistics and inflation costs stemming from Middle East conflicts and shifting global tariffs. It's a tightrope walk.
Taking all of this into account, our blended verdict at the current price of $39.66 is a hold. The company absolutely has the balance sheet to survive this transition year, but the defensive framework suggests patience is warranted until those earnings stabilize. But it leaves us with one incredibly compelling question to ponder. If management actually hits that $300 million cash flow target, is Sylvamo's short-term cyclical pain actually a long-term value investor's dream? I'll leave that for you to decide. Thanks for joining me in the gauntlet today, and as always, keep learning.